Welcome to Lesson 1 in Module 4, Real Estate Financing Basics. In this video, we will be covering the fundamentals of real estate financing, which is an essential component of any real estate investment. Whether you're a seasoned real estate investor or just starting out, understanding the different financing options available is crucial for your success. In this lesson, we will cover real estate financing basics. The learning objectives of this lesson are to understand the basics of real estate financing, identify different types of real estate financing options, and analyze the advantages and disadvantages of different financing options. Real estate financing is the process of acquiring funds for the purchase or development of real estate. There are various types of real estate financing options available, and each option has its advantages and disadvantages. Understanding the basics of real estate financing is essential for every real estate investor. One of the most common types of real estate financing is a mortgage. A mortgage is a loan that is used to finance the purchase of a property. The borrower pledges the property as collateral for the loan, and the lender provides funds based on the value of the property. The borrower then makes payments on the loan, which include both principal and interest. The advantages of using a mortgage to finance a real estate investment include the ability to purchase a property with a lower initial investment, the ability to build equity over time, and the tax benefits associated with mortgage interest deductions. However, the disadvantages of using a mortgage include the risk of foreclosure if payments are not made on time, the requirement for a down payment, and the potential for high closing costs. Another type of real estate financing option is private loans. Private loans are loans that are provided by private investors or companies, rather than traditional financial institutions. Private loans are typically used for short-term financing needs, such as bridge financing or fix-and-flip projects. The advantages of private loans include the ability to access funds quickly and with less strict underwriting standards than traditional loans. However, the disadvantages of private loans include higher interest rates and shorter repayment terms. Equity financing is another real estate financing option that involves selling a percentage of ownership in the property to an investor in exchange for funding. Equity financing is typically used for larger real estate projects, such as commercial developments or multi-unit apartment buildings. The advantages of equity financing include the ability to access large amounts of capital without taking on debt, and the potential for higher returns if the property value increases. However, the disadvantages of equity financing include the loss of some control over the property, and the requirement to share profits with the investor. When analyzing different real estate financing options, it's important to consider factors such as interest rates, repayment terms, fees, and the potential risks involved. By calculating the costs of different financing options and developing a financing plan for a hypothetical real estate investment, you can determine the best financing option for your specific needs. Thank you for watching this lesson. We hope that this video has provided you with valuable insights into the world of real estate financing. If you found this video helpful, make sure to check out our upcoming videos in this Real Estate for Beginners series, where we cover various topics related to real estate investing.